Thank you very much. Good to be with you. Thanks to Capital Account. Thank you to BPI for hosting us. And I know you're excited to hear me talk about the speaker's race. No. I'm happy to talk about bank regulation in a minute, but let me, in all seriousness, let me give you an update on what I know. Mike Johnson appears to have united the Republican conference, and I think we may be voting on a speaker, a consensus candidate speaker. So the dysfunction of the last 3 weeks may be mercifully coming to a conclusion. We had a preliminary vote in the conference last night after we've moved through McCarthy, Scalise, Jordan, and Emmer, and I think the conference has settled on a consensus pick in Mike Johnson. For those of you who don't know Mike, he's a congressman from Louisiana. I think he's in his 4th term, maybe. He's an intellectual conservative. His background is in the law and policy work. He's worked for religious organizations on religious freedom issues. He is on the Judiciary Committee. He served as chairman of the Republican Study Committee. He has relationships with all factions and sub-factions, which I think serves him well in this moment. And I think he is poised to unite the conference today. So I think this is different from what we've seen over the last 3 weeks. I think we will have a speaker by the end of today, which is good because we have a lot of work to do, and we can get back to the important oversight that we need to do. Lots of year-end work to be done in terms of the appropriations process, the supplemental requests from the White House, a lot of foreign policy, as you know, pressing foreign policy issues facing the country. And so having a speaker in place is very look forward to hearing from him. Let me just touch briefly on the work of the House Financial Services Committee and our oversight of the Basel III Endgame proposals, the regulatory capital proposals. There's lots going on in the Financial Services Committee and oversight, but I'll focus my remarks on the bank capital proposals. So as you know, end of July, Michael Barr proposed and the Fed proposed and the other bank agencies proposed a sweeping rewrite of federal bank capital rules. This was I think a more important issue than a lot of my colleagues realize in terms of reshaping the U.S. economy. And I'll just start by saying I think it's a regulatory non sequitur. You've heard this before, but it's not responsive to the bank instability that we saw in March. There's kind of a proximate cause of the bank instability, the bank failures, Silicon Valley Bank, Signature Bank, First Republic, and an underlying cause, as I diagnosed it. The proximate cause was bank mismanagement, interest rate management problems at those institutions, and deposit concentration risk, certainly at Silicon Valley Bank. What it was not was a bank capital problem. What it was not was an operational risk or market risk issue. And it was, in the proximate cause, a bank supervisory failure. And so I think, the San Francisco Fed, the state California bank regulator, they do need to look in the mirror and look at what failures they, were part of in the run-up to those failures. And I think there's some legitimate policy issues that the Congress can look into in the next year. Looking back at those, deposit concentration, looking at the deposit insurance system, other things. But at the core of it, this was a supervisory failure. It was an interest rate risk mismanagement failure, and so that leads me to okay, well, what was the underlying cause? The underlying cause, as I see it, was why did the Fed have to raise interest rates so rapidly? That creates a supervisory challenge, a bank management challenge. You had a Federal Reserve that misdiagnosed inflation and waited too long to tighten monetary policy. And so as a result, the Fed had to tighten monetary policy at the fastest clip in its history. And that's challenging when you have banks that are invested in long duration securities and have to adjust very, very quickly. So I think the regulators had all the tools, the bank supervisors had all the tools that they needed in this case, but they're using the bank failures in March as an excuse or a pretext to do what was pre-baked, which is what Mr. Barr, who I have immense respect for Mr. Barr, he's a smart guy, but we have a disagreement. It's Barr versus Barr. It's like Kramer versus Kramer. But we're gonna have a robust conversation about what is the right policy response to bank failures. And I don't think this is the right policy response because there's going to be many unintended consequences as a result. So one of the criticisms is we're responding with the wrong policies to what actually caused the bank failures in the first place. Secondly, the process is flawed. We don't have the rigorous cost-benefit analysis that is required in the Administrative Procedures Act. We've asked for a cost-benefit analysis. We've asked for the quantitative analysis that would justify such a sweeping change in rewriting the bank capital rules, and we haven't received it. We actually asked for that before July 27th. It was a bipartisan request from me and Ranking Member Foster. We didn't get anything. 2 months later, Vice Chair Barr did give us a response that just kind of reiterated what he was proposing, but without the cost-benefit analysis, the quantitative analysis that we had requested. What they are doing now is they are requesting some data from the banks, but it's too little too late in terms of the comment period. And if they recalibrate, as they say they will, and adjust, well, if you're going to have a new proposal, but the comment period is over, that to me is a significant administrative procedural flaw in what it is. Then on the substance, so you've got procedural problems and you have substantive problems. What are the substantive problems with the Basel III Endgame proposal? Different estimates, we don't know for sure. The Fed itself is saying a 16% increase in capital. We've heard estimates of 20 or above. Sidelining that level of capital when capital inadequacy was really not at the core of what caused these bank failures, that is a significant policy ramification that will impact the real economy. At a time when we're trying to combat inflation, sidelining capital that the economy, that is not helpful as the Fed continues its tightening project. So that's a problem. When we have commercial real estate maturities coming due in a big wave over the next few years, $1.5 trillion in commercial real estate, it's going to be hard enough to refinance at much higher rates and to sideline that capital and set aside the liquidity that's going to be required to deal with that wave of commercial real estate maturities. That is a big problem for the real economy. Housing, municipalities, small businesses, all of these participants in the economy will be negatively impacted by the inability of the bank sector to deploy that capital and provide the credit at the affordable levels that is required for the economy to continue to recover. I have asked the question of the bank regulators, have you checked with the White House? There's an election coming around. Do you want to be responsible for putting the economy into a recession at this time? Because I do think that this is a real problem for the economy in difficult times. The idea behind Basel III was harmonization, and that's not what's happening here. In fact, this gold plating business and putting U.S. firms at a competitive disadvantage, this is real. The Basel III Endgame was supposed to be capital neutral. That's not what's happening with this proposal as we see it. We want to ask and probe with Mr. Barr what he thinks about this, but what the banks are telling us is that this will definitely put U.S. firms at a competitive disadvantage. It doesn't achieve the objective of harmonization On the contrary, it puts U.S. firms at a competitive disadvantage, and a significant one of that. Also, what does this do to regional banks? I'm very, very concerned about this. Effectively, the proposal is a de facto roll agencies, unelected regulators, and we have some in the room, and I respect you, but I don't think that they have the authority to actually repeal a statute. Now, Michael Barr would say he's not doing that he has the statutory authority to do this, but de facto, this is a rollback of a congressional directive to tailor regulation. And again, you know, I don't think we need a one-size-fits-all approach to bank regulation. I don't think that the risk profile of regional banks, certainly small regional banks, is the same as the largest GSIBs. What we want, and here's how I'll conclude with this, what we want in our, if you care about financial stability, if you care about economic dynamism, and if you care about a robust, competitive American banking system, what we want is diversity and strength, and the diversity of our banking system is our strength. I come from a community bank-centric congressional district, Central Kentucky. We are dominated by community banks, relationship banks, but we have our share of regionals, and we also have JP Morgan serving our market. But the United States depends on all of it. We depend on the community banks, we depend on the mid-size, the regionals, the super regionals, and of course the GSIBs to serve multinationals and market making and other activities that cannot be served by these other institutions. We need it all. What we don't need is a one-size-fits-all regulatory capital framework that forces banks into one model, and that where we lose that mid-market banking sector, and we have a barbell system where we have, you know, a smattering of community banks and a few utilities, bank utilities, that deprives the American economy of that dynamism that gives us our competitive advantage. And so these are serious questions. We are going to be asking Michael Barr these questions in our oversight and the other regulators. And I'll just finish by saying this. I had a very positive conversation with Chairman Powell last week about this. What was encouraging about that conversation is that, and he's a collegial guy, he respects Mr. Barr, as we all do, but he respects the statutory role that was created in Dodd-Frank for the Vice Chairman of Supervision. And he said it is the statutory role of the Vice Chairman for Supervision to propose regulatory supervisory changes. It is not the Vice Chair of Supervision's job to finalize. And it is the board's decision ultimately. And that was an encouraging comment. And we have pressed Chairman Powell over our oversight process to live up to his commitment to consensus on the board. And there is clearly not consensus. And it's not just Bowman and it's not just Waller. It's Chairman Powell himself who has expressed skepticism over the original proposal. So we're going to hold Chairman Powell's feet to the fire on that point, and we're going to insist on consensus as they review and revise this proposal in the coming months. So with that, I will yield the floor, and I'll be happy to take your feedback, your comments. If we're on track or off the mark, I want to hear from you all. Thank you.
You don't get to totally yield the floor, but I'm Rob Smith with Capital Account. Thanks for coming, and thanks, Congressman, for jumping in and doing this. We appreciate it.
Thank you.
And you sound pretty relieved that maybe the speaker morass is over.
Certainly hope so. Certainly hope so.
I guess that means you get Chairman McHenry back, and the committee can kind of start getting up to speed again. What's on his agenda? What's on your agenda as we go the next couple of months?
Well, I'm pinch hitting for him. He's a bit busy as the Speaker Pro Tem, but he is excited to get back to his day job, I know. And Patrick's a great leader. I think he's helped me in our oversight of this bank regulatory issue. But as you know, those of you who know the chairman, he is very laser focused on getting this crypto market structure bill and the stablecoin bill done. The House has provided some, we filled the void, if you will, with Patrick and French Hill's leadership on this important issue. I know banks have an interest in stablecoin legislation especially. But we do need some regulatory clarity in this space, and I think that the National Defense Authorization Act could be a vehicle for Chairman McHenry and Chairman Hill to move their products. And I do think it has national security implications. I think the dollar's dominance is at issue as there's innovation in this space, and so I think they're going to try to use that as a vehicle. In addition to that, there's so much activity at the Securities and Exchange Commission. Our oversight is extensive, but we need that oversight because of everything that's going on with Gensor's agenda, which is unprecedented.
So let's get to the topic at hand. When you came into Congress a decade ago, do you think you'd be kind of the point person on Basel Endgame?
Didn't know what Basel was. I have a funny story about a colleague of mine, Democrat colleague, a friend of mine, Carolyn Maloney. I'll call her out because she was very public about this. So she, when we went to Switzerland, we actually went to the Basel committee and we met with them, and she said, I represent the big banks in Manhattan. I'm a senior member of the Financial Services Committee, and all I ever hear is Basel this and Basel this, Basel that, and here I am in front of the Grand Basel Committee. I don't know if I should bow. No, I didn't know how influential these international bodies could be, but I recently sent a letter to the GAO asking for a little bit more transparency in what is otherwise, I think, a pretty opaque process of U.S. bank agencies interacting with these international bodies. And by the way, it's not just Basel, it's the Network for the Greening of the Financial System. It's our participation in the Financial Stability Board, all these other international bodies. And I think there's a legitimate concern on the part of many members of Congress that we just, on a perfunctory basis, import international rules into our own regulatory system, and that could impede our competitiveness.
Yeah, talk a little bit more about that. What do you want the GAO to look at here?
I want to look at, our counterparts in Europe. What information is being shared? What feedback, are we getting? Why is it that in a Basel III Endgame project where harmonization is the stated goal, why then are we deviating in the wrong direction? Why are we making it even harder for U.S. firms to compete? So just getting a little bit of insight into, what we're doing.
Yeah, and you have made that point, but it's an interesting process if the U.S. banks come out at the bottom of this.
Exactly.
How do you kind of, when you look at kind of the rationale for this, and I think part of the gold plating comes from the SVB crisis, like you talked about, in the regional banks. But at the same time, during that crisis, we had Vice Chair Barr, we had Chairman Powell, we had Secretary Yellen all saying, hey, our banks are well capitalized here. The system is fine. So what's kind of the mismatch here?
Well, great point. And we try to remind Chairman Powell, Secretary Yellen at every turn that this is what they said just months ago, that our bank system is very well capitalized. And so what gives here? Look, I do think we have some lessons to learn from the bank instability that we witnessed in March. And we have to take that seriously. I mean, there's a reason why the systemic risk exception was invoked. There was real panic. There was real concern. So we should take it seriously. And we believe that banks need to be well capitalized. But they are. I mean, frankly, after Dodd-Frank, there was, and I'm a Dodd-Frank critic, but you cannot argue that the banking system is more resilient today than it was pre-2008. It is. And most of these banks don't have a capitalization issue. Now, there are some liquidity issues. There's arguments about deposit insurance, especially when you're talking about big transaction accounts. But to sideline 20% of bank capital right now, and by the way, the credit needs of the country are not going away. You will reshape finance in America. Credit will come more expensive. It will come from different places, but banks will be sidelined as basic government utilities, and there will be the financing needs of the country will be met elsewhere. Is that positive for financial stability? Legitimate question.
Yeah, and speaking of financial stability, is when there are these problems with the
Yeah, exactly. Again, our objective should be to protect and preserve the diversity of our banking system, and these bank capital proposals appear to be designed to, force banks into a kind of a single model.
And as you pointed out, that this is coming at a time of high inflation, credit crunch. Maybe it's good for the GOP coming into an election year.
Right, but that's not what we don't want to. We don't want to create an economic catastrophe just for political reasons. That's the opportunity for prosperity, upward mobility, and our country is a free market capitalist country. We need to protect that and preserve that, and we need a strong banking system to facilitate that. But we also need to make sure that we look at the cost-benefit analysis. A resilient banking system, but one that can support the credit needs of a robust, dynamic free market system.
You talked a little bit too about kind of capital becoming politicized here with the Biden regulators. What do you mean by that?
Well, there's no better example of that than what we see and I acknowledge this is a politically charged topic, but ESG. Banks shouldn't be Democrat or Republican. I don't like the idea of a bank being the Democratic bank or the Republican bank. They should not be catering to political agendas. There's a bill that the banking sector opposes that I've introduced. I actually would prefer that this not be a proposal that would be required, but this fair access rule that Senator Kramer and I proposed that says, look, if you're a credit-worthy borrower, I would prefer that bill not need to be introduced. But this idea that we're going to interject politics in underwriting decisions, I think is wrong-headed. I think banks that get into that game are doing so at their peril. I think asset managers who do that and allocate capital based on politics, I think they do that not only to their peril, but they do that to the detriment of investors. And so I would prefer these decisions, credit risk decisions, be made without reference to whether it's politically popular or not.
Kind of at the same time, you've written some bipartisan letters to the Fed on the capital plan. So tell me, when you talk to your colleagues on the other side of the aisle, this is not kind of just a Republican issue, is it?
I was very encouraged and heartened by the bipartisan tone of some of our first hearings after the July 27th proposal came out. I think we had effective oversight hearings precisely because we had so much Democrat participation and interest and pushback. Sean Caston, who is my friendly nemesis on ESG issues, smart guy, wrong on a lot of things, but a friend. We had Congressman Scott from Georgia push back on low-income housing. So Democrats got into this game and talked about the end users and how this could really negatively impact their constituents.
And speaking of oversight, your committee is kind of the main Fed oversight vehicle on the Hill. And you've talked a lot about how Congress has been left in the dark on this plan, and certainly the industry feels like it's been left in the dark on some of this.
Yeah, that's never conducive to sound policy making when we don't even know what data they're relying on to justify some of these sweeping changes. So our job is to shine a light on it, urge and demand more transparency, and if they do ultimately provide the data, they need to repropose it. You know, they put this out as a notice of proposed rulemaking. Mr. Scalia can talk about administrative law requirements, but they should have done this as an advance notice of proposed rulemaking if they had not done the rigorous quantitative analysis. So that now they're asking for all of the data to justify the proposals. Well, they're going to need to repropose it to not run afoul of the administrative law requirements.
Well, and you were an administrative law specialist too, back. Well,
Exactly. Big process concerns, and Vice Chair Barr and I have met before. We met before. We talked about what he was planning on doing. He has asked for another meeting in advance of his appearance before the committee. So I'm happy to meet with him again, and we can pose these questions in person. But we're not going to relent. We're going to hold his feet to the fire. And again, this has real big ramifications to our economy. Most of my colleagues don't follow bank regulation issues, frankly. Those of us on the Senate Banking Committee and House Financial Services Committee, we are forced to. But what we have said to our colleagues is this is a big deal. This is a really big deal for your constituents and for our economy. And if we don't watch it, if we get this wrong, we will put the economy into a recession.
one of the other points that you've made is that there's a lot of stuff going on, and that this is not just a kind of a standalone proposal, right? There's interactions, there's a GSIB surcharge, there's long-term debt plan, there's living wills. Talk to us a little bit about that.
Well, I don't think the regulators have, adequately considered what these proposals will do in tandem, in combination with one another. With everything that the Securities and Exchange Commission is doing to impede, market making, in the non-bank sector, in securitization, conflict of interest rules, the private funds rule, all of these things that are that will impact availability of capital from non-banks, in tandem with this bank proposal, sidelining all of this capital and the operational risk and the market risk piece of this. Where is the economy going to access capital if all of this happens all at once? It is central planning at its worst because the left hand is not talking to the right hand. And so we are sending letters to, for example, the bank regulators. By the way, has the SEC consulted with you about how this is going to impact you? And by the way, asking Michael Barr, have you consulted with Gary Gensler? And where are people going to go to access the capital that they need to fulfill the needs of the economy? And I think all of this happening all at once is a cold, wet blanket over the U.S. economy.
Two more quick questions, and we'll see if anybody in the audience has any. But you had written to Vice Chair Barr, and then I just saw another letter. You just said you weren't that thrilled with his response, which you talked about.
Yeah, there was no answers to any of our questions. So we sent off another couple of letters, one to Powell, one to Barr, again, asking for more specificity. We actually ask the questions for a reason. We actually want answers to those questions. We don't want a restatement of July 27th.
And you touched a little bit about this in your remarks, but you also noted that the Fed governors, the FDIC board members, there was some wide variety of opinions here, and there were reservations from Chairman Powell and Vice Chair Jefferson. What does that mean to you? Does that mean that you think maybe we need to slow down and have a reproposal?
Absolutely does. The lack of consensus, the serious and strenuous objections from some of the board members, I think, puts Vice Chair Barr in a position where he's got to move uphill. And so we're going to urge consensus, slow down, repropose it, consider the objections. And by the way, when you talk about the accumulating effect of all of these regulatory proposals, the FDIC and the OCC are getting in on the act with long-term debt, the resolution planning revisions. Also, Megan, my staff, who does a great job, she informed me that they finalized, or they're getting to finalize the CRA rewrite, the principles for climate-related financial risk. I mean, it is a avalanche of regulatory red tape coming out of the agencies. And slow down, take a breath, people.
At least it gives us all something to do, right, I think.
Yeah.
So yeah, does anybody have any questions before we wrap up? We have time for a couple, if anybody does.
Yes, sir.
Maybe I'm cheating because I actually work at the Bank Policy Institute, but my name is Josh. I had a question on the tailoring bill. I've been leading the long-term debt work stream for BPI with one of my colleagues, and we're really concerned by the fact that tailoring isn't really present in the calibration for the long-term debt proposal. But one thing we found with S2155 is the actual statutory language applies to the Fed and bank holding companies. Has there been any thoughts or discussion about amending that legislation to cover all bank regulation, to cover IDIs and banks and other agencies?
Well, that's a great idea. I'd love to work with BPI on that proposal. If we do need to, look, we can revisit S2155. It's not the Ten Commandments brought down from Sinai. Look, if there's some changes that we need to make, and we may have given the agencies too much discretion in 2155. By the way, we voted for the Financial Choice Act before S2155. It was a bipartisan compromise. So yeah, if BPI has some good ideas on changing that legislation in ways that would achieve the objective that I outlined, preserving the diversity of our banking system. I am most concerned about regional banks right now. I am most concerned about that mid-tier, the mid-sized banks who lost a lot of deposits in the aftermath of the SVB, all that deposit outflow that went uphill. I'm worried about them. They're very worried. I'm worried about regional banks. And one thing I am working on right now is, look, if we want to protect and prevent the deposit insurance fund from having to resolve some failed bank situations, we do need to reform our bank merger process. And there are a lot of healthy mergers that will need to happen. By the way, they're going to need to happen because of online banking and technology. They're going to need to happen because of just regulatory compliance pressures. They're going to need to happen because they just can't, some regional banks can't compete with GSIBs. It is better for our system if we have healthy mergers in the regional banking sector space. And we don't need another TD First Horizon scenario where you've got these merger applications that sit in regulatory purgatory. We need approval. Protect the deposit insurance fund from bank failures. We need mergers to happen in advance of Silicon Valley Bank. So I want to look at some legislation. I'm working on legislation that would put some real hard and fast deadlines on the process. And not just with the bank regulatory agencies, but also with the Department of Justice. They have an important competitiveness analysis to do, antitrust analysis to do. but there needs to be a sequencing where you have bank regulatory safety and soundness analysis of the merger, and then there is a quick move to the Department of Justice on the antitrust piece, but there has to be a decision. There cannot be a protracted process where there is indecision that deters healthy mergers.
Good. Anybody else? Good. Well, thanks, Congressman.
Hey,
That was
thank you very much.
terrific.
Thank you. It's good to be with you all.
That's great. You took away my talking points.
Well, I wish I could show you that. Presentation. Keep it up.
Hi there, I'm Jesse Westbrook, co-founder of Capital Account, along with Rob Schmidt, who you just saw with the previous panel. I wanted to just briefly thank all of you for coming today. It's our first ever event. We're very proud of what we've achieved over the past year, and I want to thank BPI for providing this amazing venue. One thing I want to mention is everyone who is here today, we are going to give you 2 weeks comp of our daily newsletter. Please look for it in your email boxes starting this evening. If you don't get it, if you don't see it right away, check spam. Hopefully you'll enjoy it. We appreciate feedback, anything you have to say, both positive and negative, and story ideas. We love story ideas, so send them our way. This is hopefully the first of many events. We cover closely the world of, Congress, financial regulatory policy. So this is the kind of thing we want to do more of. And with that, I'm going to kick it to my colleague Jessica Holzer and our final panel. Thank you.
Hi, everyone. I'm Jessica Holzer. I'm a reporter with Capital Account, and we'll just dive right into our introductions here. I, like to say hello to Greg Barr. I think everybody knows that he's the president and CEO of BPI, and I'll just say a few words about him. He's had a long career in the banking industry, including top regulatory and legal roles at Bank of America and JP Morgan. But he also was a litigator in private practice for some time. And when he helped launch BPI, he really wanted to bring this fighting spirit, and he called it pirate spirit, to BPI. And he actually had a BPI pirate flag hoisted in the office, and I think it hung for some time. I don't know, it's obviously not up anymore, but I don't know,
Not in
maybe
a fancy new office.
Not in the fancy office, well. And I should also mention he was a top official in the Clinton Treasury and also worked for several years in the General Counsel's Office at the Fed, so he has a regulatory perspective as well. Next, I want to welcome Jason Goldberg. Jason is a managing director and senior equity analyst at Barclays, and he's followed large banks for about 25 years, so he's got just a ton of insight on the sector. We're really happy to have him. He came all the way down from New York. He's going to give us the Wall Street view. Years. He's put out a widely read email newsletter on the bank sector, and it's called Bank Brief, and it's read by regulators, by CEOs, big CFOs, and it's I think it's pretty much must read at BPI, right? So anyhow, he gets into the office every day at 5:45, so it hits people's inboxes at 7:30, and then I'm sure that's something most of the people in this room could not imagine. So, and then finally, I'd like to introduce Gene Scalia. He is a partner at Gibson Dunn. He's a former labor secretary in the Trump administration and was solicitor for the Labor Department department in the Bush administration. Gene has pioneered the practice of suing to overturn agency rules. So that's why we have him here today. He is an expert in the Administrative Procedures Act. And really, with all the buzz about suing Biden regulators and challenging their rules, he's the go-to lawyer these days. He is representing the private equity and hedge fund industry in their challenge to the SEC's private funds rule. He's also advising BPI on a potential challenge to the Basel Endgame and other bank regs. So, as one source put it to us, Gene Scalia is going to be able to buy an airplane by the time this is all done. Anyhow, so welcome. Let's get started here. I'm going to start with you, Gene. Is it a good time to sue your regulator?
Only if they do things that force you to take that action. I think that the courts are very focused on administrative law right now, partially to your question. I've been doing administrative law a long time. It's a topic that I used to approach with some hesitation for fear that people would walk away or fall asleep. But I would say in the last 10 years or so, I've seen that people actually want to engage me on it, and that's because the Supreme Court is so focused on the power of the administrative state, the abuses by the administrative state, overreach by the administrative state, and I think the current Supreme Court of the issues it's focused on, I believe that this sort of re-examination of the administrative state that's underway at the court right now could well be the defining issue of the broader Supreme Court. We've got 3 cases in the court this term that are administrative law, constitutional law cases drawing a lot of attention. That's the CFPB case, the Loper case where the court is asked to reconsider the so-called Chevron deference doctrine, and then the Jarchese case involving 3 different constitutional infirmities to an SEC prosecution that were found by the Fifth Circuit. And so you've got a Supreme Court very dialed in on the administrative state. They plainly have concerns about excesses within the administrative state. And I think part of what you're seeing is regulated entities recognize that and are more comfortable now coming to the courts when they think something's been done that's unfair or wrong. And then just to kind of wrap up the answer, Jessica, you do have some regulators right now that are serving up a lot of softballs to the federal courts. And it's a strange dynamic where the court is saying, in so many words, we are concerned about the size and power and fairness of the administrative state, and we're watching it closely. And then you've got regulators saying, we are looking for workarounds. We are finding a way to use the powers that we have to achieve big things even in the absence of clear congressional authorization. And that's exactly what the courts are looking out for. And so we've seen this sort of clash between aggressive financial regulators that are walking right into it.
Interesting. So, Greg, from your perspective, I mean, it's been some 20 years before there, since we've seen any significant challenge to a bank regulator. And now there's all this buzz, suing over Basel, suing over CRA, suing over the stress test. What has changed from your perspective?
Well, I mean, part of it is, I think, a belief that the courts are probably more receptive, although I think that's the minor factor. I mean, I think the more major factor is, freedom's just another word for nothing left to lose, I guess is one way to put it. Or as I described to somebody the other day, you can be the frog boiling in the tub and you don't really notice, but all of a sudden the bubbles start to appear and then you think, well, maybe now it's time to get out of the tub. And, I think, over time, I think there's been, good moderation in a lot of the regulation. I think, coming out of the global financial crisis, for example, certainly there were aspects of the proposals that the industry objected to, but I think most people thought that it was a proper response to have higher capital, higher quality of capital, have some liquidity regulation. But I think this last one has moved into a level where banks cannot, they believe, continue to do the business they ought to be doing. And it's pricing them out of certain businesses. And then you combine the Basel proposal with the stress test, where again, I think everybody's sort of whistled past the procedural graveyard there, in the sense that can you really have a stress test with secret models, with effectively no right to appeal, and where the scenarios are put out without notice and comment. And then when you add those two things together, that's a pretty potent government hand in terms of credit allocation, in terms of determining what businesses are viable for banks. And it depends a lot on which business. There's some businesses that fare fairly well under Basel. There are others that are at existential risk. But I think everybody's sort of got a hand in one of those, so they're concerned. And then I think the congressman noted it. I think also for regional banks now, there's deep concern about the business model. There's a fundamental belief that they've sort of been betrayed on tailoring, and I think that has made them more receptive to arguments like this.
Stepping back, can you tell us what a capital requirement is and what it has to do with lending?
Okay.
Just big picture.
I'm going to try to let Jason make through.
No ratios, no.
Because this is going to be really okay. So I do that, actually, I teach a law school class, so I actually did this a couple of weeks ago, so see if you guys are as good as Georgetown law students. Capital is basically a cushion to absorb losses. Technically, it's the difference between the value of your assets and liabilities. It's how much you can lose before you don't have enough money. It's a good thing. It keeps banks from failing, promotes financial stability, but it has real costs. There's a formula at the Basel Committee. For every so much increase in capital, there's a permanent reduction in GDP. And so that's important. Capital ratios basically say how much capital you have to hold against a given asset. So if you have an 8% capital requirement, say, that means if you make a $100 loan, you have to hold $8 of capital against that. That's generally considered a fairly risky loan. So the question is, do you want to hold the same amount of capital against every asset, whether that's a subprime mortgage loan or a treasury loan? Or a treasury bill. The leverage ratio is sort of a mindless approach to capital. It says, yeah, we're going to hold the same amount of capital. But Basel and all its predecessors is about if you have a 50% risk weight, that means you're going to hold $4 or 4%. And it's a really hard business. I mean, I don't understate that at all. Because if you get too granular, you're allocating credit. If you're too general, then you have kind of a dumb rule. Basel I, which was the approach when we had the global financial crisis, basically divided assets into only 4 categories. All corporate loans were treated the same. All mortgage loans were treated the same. They had a 50% risk weight, so $4 for a $100 loan. And treasuries still are 0% risk weight, so $0 of capital against a $100 treasury bill. So I think everybody felt that was a little too broad, and that's now what's gotten into this debate. Do you use bank internal models, which are much more accurate, but come with some risk of gaming? Do you go to a standardized model written in Basel, and just have the government determine it at a very broad level? Or do you have sort of a compromise, which is actually what was devised in Basel in 2017, which is use the bank models, they're more accurate, they're more granular, they're more risk sensitive, but will basically say they can only take capital so low. They actually came up with a number, 72.5% of what the standardized model shows. That was sort of the compromise. Bank model is more accurate, but we'll have a limit on them just to make sure things don't get out of hand. And one of the things that's controversial about the current proposal we're not going to be at 72.5%. We're going to be at 100% for everything. And then we're going to add extra charges on top of that standardized model. And I think that's where you see, in a proposal that purports to be an implementation of Basel, it's sort of odd in that it's a repudiation of the core belief of Basel, which is retain bank internal models subject to a he didn't. That's good.
So what are you hearing from your members about what the proposal would do, just sort of in terms of their overall capital requirement?
Sure. You see numbers. I think the agency says 16%. I think we think it's going to be higher on average. But as my friend Jeremy likes to say, on average, World War II was a tie. So some are a lot higher, some are a little lower, and it sort of depends on your business mix. Clearly, under the proposal, the best thing you can do is be basically a bank that all it does is make loans, because even though they have not taken full account of Basel, there is still a little more granularity in terms of credit risk. So you will see generally lower capital requirements for credit risk. That's generally offset by higher charges for operational risk. We can get into that if you want, but that's basically the risk of a cyber attack, or more likely a $1 billion fine from your regulator. So generally credit risk takes you down a little, operational risk brings you up. For banks that do nothing but lend, they're probably up, guessing 5% as a result of that. Banks that are really hurt by this, banks that rely on fees, again, because of some eccentricities in the operational risk charge. If you rely on fee income, your charge is going to go way up because they're assuming you're going to have more adverse judgments against you. Not terribly rational, but that's what's in it. So if you're a credit card bank, a charge card bank, if you do a custody business, if you do investment banking and depend on fees, ironically, which the agencies over the years have encouraged banks to move from net interest income to fees as an income source, but you're punished for that under this proposal. And then the biggest charges really come in capital stability and low risk, but the numbers are at a charge around 70% higher in capital, which for certain desks, for certain businesses is truly existential.
Great. So, Jason, are equity investors paying much attention to this, and what do they think of Basel?
Yeah, no, I think there's intense focus from the investment community on the ultimate impact on Basel. I think for several reasons. I think first and foremost, if you're a bank stock investor, return on equity is kind of a key profitability metric that people look at, which is basically net income divided by equity in its simplest form. And if equity requirements go up, all else equal, your returns go down. So, for example, a company that take JP Morgan for example, they target a 17% ROE. Assuming risk-weighted assets go up by 25%, as we estimate, all of a sudden, all else equal, that 17% goes to 14%, because you need more capital to support a higher asset base. If you kind of look at, historically, kind of price to book multiples as a way that investors value bank stocks. Historically, bank trading at 17% ROE trades at 2 times book, bank with 14% ROE trades at call it 1.5 times book. All of a sudden your value of your investment's been cut in half. All else equal. So the banks I don't think will sit still and accept 300 basis points of ROE degradation. But certainly that's a lot of uncertainty I think weighing on bank stocks at the moment is, all right, how are they going to make up for the shortfall? Get the rules kind of going as proposed.
Right. So yeah, what are you hearing about what they're going to do, and tell us, are they actually going to have to raise capital and issue?
$175 billion on the 20 banks that we focus on. We don't expect banks to have to issue equity to meet these proposals, but they're going to have to do certain things. If you think about it, for the biggest banks, they're mostly impacted by this weighted asset increase. For the regional banks, and Barr talked to this, because of tailoring, they're able to exclude unrealized losses from their capital calculation. And you already are seeing some companies take actions. So you've seen, for example, Citizens Bank stop making auto loans. You saw Truist last quarter sold the student loan portfolio. You've seen, other banks kind of pull back on unfunded commitments. So they're already taking action despite the fact that these rules aren't set to start to go in place until 2025, and then phased in through 2028. And there'll certainly be other I think other things as the rules kind of come clearer and get finalized that you'll see banks have to do.
Right. Will they have to suspend share repurchases and?
Yeah, you've certainly seen market slowdown in share buyback. I think if you look at all the biggest banks have certainly scaled back. They'll continue to buy back stock in the third quarter. I think that'll actually take them further in the fourth. The regional banks by and large are out of the market. In terms of repurchasing shares and basically hoarding capital to, get in compliance. And while I think the Fed kind of talks about, well, the banks will have many years to kind of adopt these new rules, the market tends not to give banks as much time. So I truly believe the regulators, will allow them to phase this stuff in. In actuality, it's not that practical, to do so. Listen, this was the slowest loan growth quarter we've seen in some time. Now, whether it's lack of demand and made higher borrowing costs and a slowing economy is certainly a component of it. But I do think it's banks being much more mindful of the assets they put on their balance sheet, given the uncertainty created by these proposals. I think absolutely played a role as well.
I just want to add one sort of obvious point that I think is implicit in everything Jason said. Banks are subject to a capital ratio. It's their capital divided by their assets. People ask questions like, well, are they going to have to raise capital? Well, if you want to improve that ratio, you have two choices. Yes, you can raise capital, increase the numerator. The other thing you can do is you can shrink your assets, decrease the denominator. And when you hear banks, and if you listen to any earnings call, particularly this quarter, you hear banks talking about risk-weighted asset optimization or balance sheet optimization. What they're basically saying is, pursuant to like selling an auto business, we're going to shrink our assets by getting out of those businesses that we think are going to generate high risk-weighted assets and therefore high capital charges. That's why, and again back to Congressman Barr's point, that's why there's going to be an impact on the economy. It's not because banks are going to add more equity in the numerator. It's because they're going to shrink their assets. And where is that lending going to come from? Is it going to come? That's the big economic impact. It's the shrinking of the assets. It's not the raising of capital.
Sure. So, pivoting off that, where do you think specifically, where would you predict the impact would come? And what do you think regulators don't quite appreciate about the impact?
Yeah, I guess, when you think about the economy by and large, I mean, if you kind of think where, things where risk-weighted assets go up a lot that kind of just don't make sense from a bank perspective is, I think credit card lending, right? It's very punitive to have unused lines of credit, so banks can certainly pull back there. They adversely impact those that, transact, those that revolve on credit cards, those that transact. So you can certainly see, pull back there. They also are very punitive to kind of lower or to high LTV mortgages. High LTV mortgages. So banks can pull back there. That's kind of a lower end consumer that's already kind of struggling, given they're most adversely impacted by inflation at the moment, given elevated food costs and shelter costs and the like. So that's I think one segment of the economy we're about. Small business lending, is another. The way the rules read, when our investment-grade public companies get much more favorable treatment from a risk-weighted asset perspective, than small businesses, and not to say, and not necessarily that's commensurate with the risk, and that's not something you necessarily see with the overseas proposals. So it could be, kind of resistance to that. And then if you kind of look to the capital market side, where this big RWA inflation is happening, you can certainly see banks kind of pull back, and that certainly has implications for market liquidity, particularly in times of stress. And again, not to say lending goes away, but does it very much has come from non-bank financials? Does it come from European counterparts? And financial services is a big export business for the U.S., right? These companies do business all around the world, and to the extent you lose some of those competitive advantages, it does highlight some concerns.
Right. Does the market risk portion, will that trickle down and affect businesses and consumers? Can you sort of walk through that?
Yeah, no, certainly I think, corporates clearly, access the capital markets on a regular basis. So if you hamper banks' ability to market make, that's a concern, right? Companies issue debt, but then banks kind of, buy and sell that debt on a regular basis going forward. And, I would say, U.S. capital markets is certainly one of our competitive advantages, right? Buy very liquid. To the extent that you adversely impact that, is certainly an area of concern.
Well, we talked a little bit about the impact. I want to shift to Jean here, and I just want to ask you, how do you think the courts are likely to view the proposal?
Well, the courts will never see the proposal, right? Let me offer my comments on the proposal and how courts might view things if there are not big changes. I want to say, first of all, the proposal and it's plain a lot of work went into it. And I don't want to be thought to disparage the work of career staff who I expect spend a lot of time on this. I'm also mindful that sometimes career staff put in a lot of work and give a lot of advice that's disregarded by senior leadership, to the frustration of career staff and sometimes the embarrassment of the senior leadership. So it's a thick document reflecting a lot of work. But secondly, to me as a generalist, and a federal judge is a generalist looking at agency action. To me as a generalist, it's an incomplete document in ways that are legally very consequential. And sitting here listening to this discussion about why is this being done, what are the impacts, what are the second order impacts, that's the kind of discussion that ought to occur in a proposing release. Here's what we're doing, here's why we need to do it, here's the good that will come of it, here are some downsides, and they're there, but here's why it's on balance nonetheless worth it. That kind of discussion is almost completely absent from the proposing release. I've joked with Greg that the proposing release reads like 500 pages of math equations preceded by 500 pages describing the math equations. What's absent is an explanation of why we need these equations, why we need to set the numbers where they are, what the target is. There are some statements that jump out at you. I wrote them down, some of what Greg and Jason touch on. There's a 4-page economic analysis. It might even be called like an impact and economic analysis in this, that's in the Federal Register, in a document that's got a couple hundred pages in the Federal Register, 4 pages on economic analysis. That alone is very striking. And I sort of cut my teeth in administrative litigation in matters involving the U.S. I kind of steeled myself to read it because I'm an English major with a concentration in medieval studies. And so, in the SEC, these are like financial regulators. OSHA's one thing, it's a safety and health regulator. You're not really going to expect much economics, but SEC, they regulate the economy. These guys are going to be really good at it. And I couldn't believe it. There was almost nothing there. It was stunning. And so the SEC's lost a series of cases over the last 15 years, often because of its stunted economic analyses, and it's worked to really build a program. I have been a deja vu. Looking at this economic analysis, it was extraordinarily short, conclusory, uninformative, but as I say, a couple things that jump out. One statement is the new rules will result in a modest reduction in bank lending with possible implications for economic growth, end quote. You read that and say, wow, I need to know a lot more. That sounds potentially very problematic. How likely are those implications for economic growth? How great are they? What's your level of confidence? The proposing release doesn't tell us that. Or another, actually even more striking, this is regarding trading. The overall effects of higher capital requirements for market liquidity remain a research question needing further study, end quote, which I would say, yes, and that is your job. So you can't go to a final rule with statements like that, because the court sees that in a final rule, they're going to say what I just did. Well, you need to do that study. You need to tell us what the impact on trading is going to be and what that's going to mean for the health of our economy. I guess I'll stop because you need to ask questions. But I very much agree with the statement Congressman Barr made, comparing this proposal to an advance notice of proposed rulemaking. I think of it as a concept release. Congressman Barr referred to the need to repropose. What I would say is that ordinarily a proposed rule is one step away from the final rule. This document is not one step away from a final rule. It requires much more explanation, and last comment, the agencies need to show their work. When an agency relies on studies, when it projects impacts, it needs to give not merely that projection, it needs to explain how it got there. And in the words of the DC Circuit, so that its claims, its study, the data it relies on are, quote, subject to refutation, quote, by commenters. This document doesn't do that, and the regulators have said they want to gather more information to finalize the rule. They're going to have to put that information out, and again, subject it to refutation. So I don't think we're one step away from the final.
Well, a follow-up for you. Don't the bank agencies have a lot of authority to set capital?
They do have the authority to do that. They do not have the unreviewable authority to do that. And by the way, I don't think they would ever claim that. I just put myself in the shoes of a federal judge, and if I had a federal regulator come to me and say, I can impose hundreds of billions of dollars of costs on the American economy and potentially cause a serious economic slowdown, roll a wrench in market liquidity and the like. And I get to do that in my absolutely, totally unreviewable discretion. Courts have no say. If I were a federal judge hearing that, I would be dumbstruck and would conclude that this is plainly a regulator that will need to be reined in. So, there's also simply the point of, all agencies at some point receive deference to the judgment calls they make. But they do in part after they've satisfied some really important procedural requirements, which is largely what I've been talking about and what Congressman Barr was talking about. And that's establishing a need for a serious intervention that is justifying in a really thorough way the particular intervention, and then that's responding to comments that are put in by the public, changing the rule in response to them or explaining why that hasn't been done. And those are all things that the agencies will need to do, and something we can talk about a little bit more, but I do think that part of the problem here is that on the one hand, there was a view that Basel III is really important and a consensus document of great international weight, and we're going to put it in place in the US, and who can quarrel with that? Well, you got to satisfy US. Congress mentioned elsewhere, there are very significant deviations from Basel III. So which is it? Is Basel III unimpeachable and definitive? Or is it flawed and incomplete and needing of improvement? That's another tension.
Right. So what about this concept of this internationally negotiated proposal? The Americans were at the table with Europeans and the Japanese, and
No, this is not a treaty. And there are some federal judges out there who would not take kindly to the notion that if unelected American regulators go overseas and strike a deal with unelected regulators from other countries, that somehow gets to circumvent US legal requirements and just get dropped into the US code. Is that the folks at the agencies working on these rules go to school on what I think of as the MetLife mistake, which is US regulators went to, I don't know what nice town in Switzerland this happened at, but the US regulators go, is it Geneva, the Financial Stability Council, making commitments I believe they did, that certain US insurers would be designated too big to fail. They come home, the job now is just to cram that commitment that was made overseas through the US legal process without being hampered along the way by the US legal process and US legal requirements. I think of that as an event like mistake, where there was a decision and commitment made abroad, it was then implemented at home, but folks lost sight of the constraints that US law placed on their decision-making process, and that ended up being an enormous legal vulnerability.
I mean, you represented MetLife in the successful suit to get rid of the label. Just lessons you learned about the courts from that case.
Honestly, Jessica, I think I probably learned more about prudential regulators than I did about the courts. I've sort of come to think that the more powerful a regulator is, it seems sometimes like the more vulnerable they are if they actually end up in court. Because I think certain regulators have so much power over the people they regulate that they're not accustomed to being questioned or explaining themselves. But the administrative process is all about questioning yourself, explaining yourself, and recognizing you are actually accountable, which is not necessarily the day in, day out of prudential regulation, for example, based on the blended of that. So I learned a bit about prudential regulators that was interesting there. It can be frustrating when you're trying to engage a prudential regulator and say, listen to this, you really need to pay attention to this, and just kind of brush it aside, and we don't care. On the other hand, that helps me build a really good legal case. Because when you ignore what the public and then in terms of, did I learn something about the courts? Courts, at the end of the day, are not mystified. They're not spellbound by any particular regulator. They are smart, capable people who they're not ever going to be capital experts, and they actually don't want to be. But they know the Administrative Procedure Act. You've seen that, you saw that in that life case, but you've seen that in some of the other financial and regulatory litigation cases.
Sure. That's really interesting. I'm going to shift back to Jason here. There have been some concerns that this proposal, if it were adopted, would entrench the mega banks, like would just make JP Morgan and Bank of America just even bigger than they are, or just more entrenched and harder to compete against. Thoughts about that?
So it's clearly the biggest banks are advantaged because it's just they are bigger and just wider customer bases to spread these increased costs over, whether it's a capital cost, or RWA increase or the like. So that certainly helps. I think Congress, right, many years ago came up with this tailoring construct to I think help kind of avoid that. And then they go, well, we hope this document kind of basically gets rid of it. I think pre-SVB, I'm not sure they would have had even tried to go that. I think it will, and I think it will. I think that's why Representative Barr talked about the need for just consolidation within the industry to get some of these smaller banks to get them bigger, to have the economies of scale to compete more effectively with the biggest banks. And whether it's regulatory or whether it's technology driven or the advantages of scale, you have seen the biggest banks kind of increase market share over the last several decades. And I think that only continues.
Is the regional banking sector, even any good to invest in at this point?
Listen, I think think, there's a lot of, I think, challenges and headwinds, on one hand. On the other hand, if you kind of just look at where valuations are, I think part of the uncertainties, they're at historic lows. So you look at, regional banks right now, PE multiple, which is another way to kind of value them, is, trading at, I'll call it 40% of S&P 500. Sort of that number's closer to 70, 75%. It's actually rare that it kind of stays below 50% for a long period of time. We've kind of been there since mid-March. So certainly there's a lot of negativity priced into these stocks, whether it's uncertainty around the economic environment, the interest rate landscape, and this new regulatory regime. There's some reason for that discounted valuation as well.
Sure. So I'm going to ask you and Greg about this other potential impact where more activity in lending flows to unregulated entities. I mean, I know it's brought up, even the regulators bring it up as a concern. I'll start with you. What do you think is a real risk?
I think it's absolutely real. And you just go back to, kind of the Dodd-Frank Act and kind of just the changes that went on within the mortgage industry. And around that time, right, there were a lot of mortgage industry and banks which had issues with servicing and the like. And you think about it, pre-financial crisis, 90% of mortgages originated within the banking industry. And now that number, I think, is maybe sub 50%. So here's one example where they made it very cumbersome for banks to originate mortgages, particularly at the lower end. Consumers still need mortgages, and you had companies like Rockgate and United Wholesaler and the like, kind of step in and fill that void. And now, right, you had some of this risk contained in the banking industry. Now it's outside the banking industry, and it's certainly been. So that's, I think, one real example where you've seen it. There's probably a lot of others.
Right.
I think you can focus too much on the fact that it's the unregulated sector. As I would like to say, you want banks to make loans, and it's not because they're smarter or nicer than people in unregulated sectors. It's because they have a deposit base, stable funding, access to a lender of last resort, and so they can lend cheaper, and they can also lend through the cycle. Because their deposits, Silicon Valley Bank aside generally, and even then, do not go away. So they are, if you're a borrower, you want to be borrowing from a bank because, first of all, they'll lend at a lower rate. Second, they'll lend even in bad times. And then also, a little more subtly, if you get into trouble with your loans, banks actually have workout programs and they hire lots of people to work out your loan. Whereas if you go to a non-bank, you're going to pay more, all things equal. You may not be able to get that loan in troubled times. And if you get in trouble on your loan, they're going to put you into bankruptcy and sell the loan. So all of that is completely regardless of whether there is prudential regulation of a bank versus a non-bank. I don't know how much benefit really for financial stability there is to having regulated non-banks as well as regulated banks. I don't remember regulators spotting Silicon Valley Bank on the way, or the global financial crisis, or the pandemic, or the to the regulated sector versus the unregulated sector. I think of it as the deposit-funded, lower-cost provider of credit and intermediation sector versus the higher-cost, less dependable, less reliable provider of that function.
So for you, the deposit base is a really key. That's a key difference.
Yeah, that's why we have banks. It's the whole notion of maturity transformation. It's you take in deposits from people and businesses and then you lend it out, and that's a good way to do an economy. And you don't want to turn banks into money market mutual funds where they aren't doing that anymore. And I think there are real costs. And again, we also, speaking of things we focus a little too much on, everybody's talking about, well, there's a looming credit crunch. The problem, that is a problem with the current proposal, is it could actually further enhance the inclination of banks to shrink in the next year or so, whenever you think the next recession will be. But the bigger issue is, this is a permanent reduction in GDP. That's what all the studies, all the formulas at Basel from the IMF, the regulators, when you increase capital permanently, you decrease GDP permanently. So whether this is going to cause, I love the notion that Congressman Barr is advising the White House on their election prospects and how they should take actions to do better. But regardless of what you think the near-term economic or political impacts are, it's a permanent reduction in GDP and jobs, et cetera.
So you're saying it's a real trade-off?
Yeah.
Okay.
I mean, and there's another side. I mean, obviously, as bank capital goes up, you're less likely to have a financial stability crisis. You're less likely to have banks fail. But that's exactly why you want to do the sort of cost-benefit analysis that Gene was talking about and run the numbers.
Well, that leads into my question. So you spent a lot of time suing the SEC and the CFTC, and they have explicit, I'll just call it a cost-benefit analysis. I mean, I think it's called something slightly different, but basically it's looking at the cost and benefits to the economy for their rules. But, are the bank agencies required to do that? Is there an explicit requirement?
There is a requirement, but it's not explicit. To explain that, the way notice and comment works and the way judicial review of agency decision-making works is that an agency needs to take account, obviously, of what commenters say. It needs to take account of alternatives. And cons. What's the good that will come of this rule? What's the bad? And another name for pros and cons is costs and benefits. Whenever a commenter can come in and show this is going to have a really serious adverse economic impact, and you are an economic regulator, you've got a serious obligation to address that adverse economic impact by altering what you're proposing or explaining why it won't happen or why it's worth it. There's a Supreme Court decision from, 2015, US v. BPA, involving, obviously, an EPA rule, where the court unanimously agreed that an assessment of costs and benefits is almost always a necessary part of agency rulemaking. So back to the Securities and Exchange Commission, we certainly regard that agency's obligation to consider efficiency, competition, and capital formation as a useful statutory obligation when litigating regarding flawed economic analyses. But actually, you can get nearly all that work done just relying on their obligation to consider comments and pros and cons, aka costs and benefits.
Okay, that's good to know. So there's been a lot of talk, and this is for Greg and Gene, but just a lot of talk back and forth between the banking trades and the agencies about data. And we want to see this QIS, we want to see it by this time. And is data the only way or a necessary way for them to justify the rule, or can they do it otherwise? Is data necessary?
I would say data is necessary. I mean, again, you're trying to project ultimately what's the risk of this asset? What's the chance that the obligor is going to default, and how much are you going to lose on average if there is a default? You can't just say, well, Basel said it was X, and we're going to add 10 to X, so it's X plus 10. And the remarkable thing here, too, is you actually have an incredible amount of data on this. You have the call reports from pretty much all the banks, you've been running since the global financial crisis these so-called advanced approaches or internal model approaches from the largest banks. So you have robust data on what the actual loss experience is, both the probability of default and the loss given default. You have other data sources. You have the rating agencies, they even have data. And to me, just the most extraordinary thing about the proposal is it includes none of that data at all. It just basically takes Basel and adds some. There was, and I think that's what you're alluding to, Jessica, there was a statement in the proposal that we're going to do a quantitative impact study and look at how much capital will go up, and although not really the secondary effects that Gene mentioned, but at least we're going to see how much it's going up. Now, of course, they had 5 years to do a quantitative impact study before doing the proposal. And there are procedural problems with saying we're going to gather the data during the proposal. But then they actually didn't send out the data templates to the banks for, I think, over 75 days, even during the comment period. So we really had 2 points. First is, well, you have to extend the comment period because you were going to do this during the comment period, and we're a third of the way through the comment period, and we haven't even got the data templates, which are extremely cumbersome to apply with. But then, to Gene's point earlier, once you have the data, well, then you have to put that out for comment. Because not just banks, people who hate banks, everybody should be able to say, okay, well, here's the data, and this argues for changing the proposal this way or that way. So I think they're, in Gene's parlance, right, they're at step one, which is, well, now after 6 years, we're actually going to gather the data necessary to make a rational decision about what the risk weights will be. But that's step one. The next step is to craft a proposal based on that data. The next step is to seek notice and comment, or provide notice and seek comment on that, and then come up with a rational rule that balances cost and benefit, or whatever you want to call it.
Yeah, and I obviously agree with all of that, and I should, remind folks, I speak also from the perspective of somebody who has been a regulator, and I've issued rules and reviewed rules before issuing them, and you have to have substantiation and explanation for what you're doing, and I think that the rulemaking requires some candor by the regulator, and ultimately some modesty too, to recognize where you need to change things because you made mistakes and the like. And data is important to all of that.
Now, in the
I think for a regulator to say to a court, this is the right thing to do because I believe it to be, based on my experience, is to a court, an agency just saying, it's right because I say it's right. And that doesn't really go over well with judges. It ends up insulating the agency from review because it's purporting to be able to rely on its own sort of undisclosed experience. It comes back to my point, all this does, that agencies need to show their work so that it's subject to refutation. That's what courts want to see, that's the process that was followed.
So I have one more question, it's for Greg.
I thought it was going to be what's Ipsa Dixit.
Oh, yeah. I think it means nonsense or something.
Oh, I'm sorry, yeah. No, it just means because, it means because I say so.
Because I say so.
Yeah, and there are rules thrown out because the courts conclude that certain statements were just basic instances.
So yes, one final question. Now, if fulsome cost-benefit analysis, they do the QIS, to your satisfaction, they re-propose the rule, and yet they come out with the same increases in capital, the same capital requirement plan. Is there a basis for a lawsuit?
Well, it's hard, I can't do that hypothetical, because we kind of know the answer. We have the data, we've seen the data.
Oh.
The data, for example, in operational risk, I think we're going to publish a note next week that shows the actual loss experience. There's actually an organization that gathers the actual loss experience, and the proposal is 3 times the worst loss experience over the last 20 years.
Okay.
So that can't happen. If they actually look at the data, the proposal will look, the final rule or the next proposal will look nothing like the current proposal. So that's not something I roll around worrying about, because there's no changes.
All right, well, that's interesting to know. All right, so I'd like to open it up. Does anybody have a question for Greg, Jason, or Jean? Yeah.
Luigi again, you this is probably a question more for Jean. Does the banking sector have to wait for the proposed rule to become finalized, or is there a way to challenge the process on an interlocutory basis? For example, the fact that they have now extended the comment period in order to complete the data collection, but at the same time, the extension of the comment period on the proposed rule coincides with the deadline for the data collection. So clearly, there is no opportunity, at least as far as the banking agencies are currently contemplating, for anyone to comment on the results of the data collection.
Yeah, what you're describing is obviously a problem. I think that if it's not rectified by the agencies, it will be a vulnerability when litigation does occur. But whether a suit could be brought now is a different question. And it's a pretty firm rule that to sue the government, you need what we call final agency action. And the initiation of rulemaking is not final agency action. there are very, very rare circumstances where an ongoing rulemaking might be challenged, but I do spend some time trying to explain to clients that that's usually not the best play.
So for Jason, so a lot of progressive members of Congress talk about record profits and how banks can afford capital increases because they're making record profits. Can you just describe why that makes no sense?
Leading the witness. Objection needed.
Yeah, I mean, I think, I guess that's at the onset, right? There's, net income and then there's equity, and you have to get a certain return on, that equity. So just because you're making money doesn't actually mean you should have higher counterparts. I kind of view them as, two different things. And then within that, there's obviously different types of banks are doing better at this point in the cycle than others. And, going forward, their economy is cyclical, and that's, that will change. So I think we should be, mindful of that.
Just want to.
Sure. You want to stand up?
Yeah, Jared Seifert with TD Cowen. Just a question for Greg on timing. I mean, this seems a little bit like Basel II, which went on for years longer than anyone expected. Where do you think, when do you think we finally get to the finish line on this? How many years down the road is it, really likely?
Yeah, I hate to dodge. I don't know. It's not my decision. I mean, again, if they do what I think the consensus up here is what they should and maybe ought, must do, which is repropose, I mean, then you're onto a very different track. Obviously, there's an election coming in 2024. It gets even more politicized. I mean, but on the other hand, for all I know, they'll just try to power through and finalize it next year. The other sort of, we haven't talked much about it at all, but certainly raises legal issues, is the stress test, where we've also raised considerable legal concerns. A component of Basel is what's called the Fundamental Review of the Trading Book, which is a terrible name for basically a huge market risk charge. And then you already have in the US and the US alone, a separate capital charge called the global market shock as part of the stress capital buffer. So I think there is a separate legal question, which again could be further delayed. Are you really in the US going to, given considerable overlap between those two charges, which I think our research has demonstrated, are you people who believe the right answer is those need to go out together as well. So just to make your question even more complicated, what's going to happen with the stress test while Basel is pending? I don't think we'd see a lot of changes for next year, but at some point they're going to have to decide. There's a huge overlap on operational risk. Operational risk is by definition a stress event. I think under the proposal you're talking about, I think it's like I think basically 2/3 of the charge would come out of Basel, 1/3 would come out of the stress test, but those are completely redundant. So there's going to have to be a further revisiting, even after or during the consideration of Basel, how you reconcile that with the stress test, which again is unique to the United States. So, answer, I don't know.
Anybody else?
Hi, Bill Nelson. So on Thursday, Chairman Powell said, banks are generally very well capitalized and highly liquid in our country. Banks are strong. We benefit from all those years of reform in Basel III that we went through with former Governor Trudeau and many others. And so we benefit from a very strong and well capitalized banking system that is much better at managing risk than the one that ended the global financial crisis. And the interviewer basically said, and I'm paraphrasing now, but you want more? He said, well, I can't really talk about it, but we're planning on getting a lot of comments, and we're going to be taking those comments very seriously. That's basically what he said. But it sounds like he sounds like he wants to rewrite the whole thing, but it sounds like there's a limit. That can't be the solution here, right? Because you can't go so far from the original proposal to the final rule and still be consistent with the law. Is that right?
Bill's an economist, by the way. This is for you, Gene.
Yeah, I mean, that question's correct. There's something, the so-called logical outgrowth rule. One of the grounds in which I sued over the SEC's private fund advisory rule is there were really pretty significant changes made to the final that were not proposed. And that's just generally the dilemma I think that agencies already are in, because they've got so much more they need to put out and do and explain, and but that's an added problem. I did also want to just briefly comment on the dissents from the proposal. When you're litigating these cases, dissents like that are extremely valuable. They help the court understand that the experts aren't in agreement here. This is not open and shut in the eyes of the real experts in the area. And so I was really impressed with these dissents. That is something that the regulators are going to have to wrestle with, because if this is up in litigation, they're not going to want dissents like that. And of course, if even the chairman of the Fed's not on board, that's an even more serious vulnerability if we end up in litigation.
Anybody else? All right. Thank you so much. I learned a lot.
You were great, by the way.